Let me ask you something. What if the difference between retiring comfortable and retiring wealthy was not working harder, not earning more, not taking massive risks, but simply averaging 3% better returns on money you were already investing? That sounds small, almost insignificant, but the math behind that 3% difference will change the way you think about investing forever. If nobody is showing you how small return improvements create massive long-term wealth, smash that like button right now, because that is exactly what this video is about. I'm Alex. I study how financial systems, investing behavior, and long-term strategy shape the wealth outcomes of ordinary people. And today, I'm going to walk you through 6 specific investment funds that have historically outperformed the broad market, what they invest in, why they have performed the way they have, and the 2-word investing strategy that determines whether any of this actually works for you. Do your own research. Talk to a financial advisor if needed. Investing carries risk, and past performance never guarantees future results. But understanding these options makes you a more informed investor. Let's get into the math first, because once you see it, you cannot unsee it. The math that changes everything. Imagine you have $10,000 to invest today. You never add another dollar. You just let it sit for 30 years. If that money grows at 10% per year, which is roughly what a broad market index fund has delivered historically, your $10,000 becomes approximately $174,000. That is already remarkable. You turned $10,000 into $174,000 by doing nothing except being patient. But now, watch what happens when the return improves by just a few percentage points. At 13% annually, your $10,000 becomes approximately $395,000. At 15% annually, approximately $660,000. At 17% annually, approaching $1.1 million. Same starting amount, same time period, same patience required. The only variable is the annual return. The gap between $174,000 and $1.1 million is not produced by luck or genius. It is produced by consistently compounding at a slightly higher rate over a long period of time. And here's what most people miss. These numbers assume you never invest another dollar after the initial $10,000. Add $200 a month consistently on top of that, and the gap between returns becomes even more dramatic. This is why getting slightly better returns matters so much, not because of what happens in year 1, because of what happens in year 30. Now, here's the important context before we get into the funds. Why the S&P 500 is the baseline. The S&P 500 is a group of the 500 largest publicly traded companies in the United States. When you invest in a fund that tracks it, you're buying a small piece of all 500 of those companies in a single transaction. Think of it like owning a slice of the entire American economy. When Apple does well, you benefit. When Microsoft grows, you benefit. When one company starts struggling and falls out of the top 500, the fund automatically removes it and replaces it with a stronger company. You don't have to make that decision. It happens automatically. Over the last century, the S&P 500 has averaged roughly 10% annually. That includes 16 recessions. It includes crashes where the market lost 30, 40, even 50% of its value. And it still averaged 10% across all of that. The key word is long-term. The investors who built real wealth through index funds weren't the ones who predicted market movements. They were the ones who stayed in through every downturn and kept buying. Now, the 6 funds I'm about to show you have historically delivered returns above that 10% baseline, some significantly above it. Here's what each one invests in and why it has performed the way it has. Fund 1. S&P 500 Growth Companies Only. The first approach takes the S&P 500 and filters it. Instead of owning all 500 companies, you only own the ones classified as growth companies, businesses expanding their revenue and earnings at an above-average pace. The slower-growing companies, sometimes called value stocks, stable but not accelerating, are removed from the equation. Over the past decade, funds following this approach have averaged returns approximately 1 to 2% above the broader S&P 500 annually, in some years significantly more. The trade-off is that value companies tend to hold up better during market downturns. By removing them, you get more upside potential during bull markets, but slightly more exposure during corrections. For long-term investors who are comfortable with that trade-off and believe in the continued growth of leading American companies, this is a relatively straightforward way to potentially improve on the standard index return. Fund 2. Technology Sector Only. The second fund narrows focus even further. Instead of all 500 companies, it only invests in the technology companies within the S&P 500, roughly 65 to 70 companies out of the 500. Over the last decade, this concentrated technology focus produced average annual returns of approximately 21%, well above the broader market average for the same period. The reason is straightforward. Technology has been the dominant growth engine of the global economy over the past decade. Cloud computing, software as a service, artificial intelligence infrastructure, digital advertising. These sectors grew significantly faster than the broader economy, and the companies leading them grew significantly faster than the average S&P 500 company. The risk here is concentration. When you reduce 500 companies down to 65, you amplify both the gains and the losses. Technology corrections can be sharp and fast. But for long-term investors with a long time horizon who believe technology remains central to economic growth, this concentration has historically been rewarded. Fund 3. Aerospace and Defense. This one is different from everything else on this list. Aerospace and defense companies build military aircraft, satellite systems, missile defense technology, cybersecurity infrastructure, and government communication systems. These are the industrial companies that governments contract with for national security, regardless of economic conditions. Here's what makes this sector uniquely interesting from an investing standpoint. Defense spending is largely independent of economic cycles. When consumer confidence drops and companies cut budgets, government defense contracts continue. When geopolitical tensions rise, and history shows they always do at some point, defense budgets tend to increase rather than decrease. Over the past decade, funds focused on this sector averaged approximately 19% annually, driven both by steady government contract revenue and by increasing global defense spending from multiple countries. This is an investment that requires its own moral consideration. A well-structured investment must make financial sense, it must be legal, and it must align with your personal values. That third filter is yours to apply. The financial and legal dimensions are straightforward. The moral one is a personal decision. Fund 4. Momentum Investing. The fourth approach is based on a concept called momentum, the observed tendency of assets that have been rising in price to continue rising for a period of time before reversing. Momentum investing funds track the S&P 500 companies showing the strongest price momentum, typically the top 100 companies ranked by how quickly their stock price has been rising, and rotate holdings as momentum shifts. This is more active than traditional index investing. The fund buys and sells positions more frequently to stay aligned with current momentum. That means slightly more activity and somewhat more complexity than simply holding all 500 companies. Over the past decade, funds using this approach averaged approximately 18% annually. The academic research behind momentum as a return factor dates back several decades and has been documented across multiple markets and time periods. The risk is that momentum can reverse quickly. What was rising fast can fall fast. This approach works best for investors who understand what they own and why, and who won't panic sell when a short-term reversal occurs. Fund 5. Semiconductors. This is the highest performing fund on this list by a significant margin, and the one with the most important story behind it. Semiconductors are the chips that power everything. Your smartphone, your laptop, your car, the servers running artificial intelligence models, the data centers storing and processing global internet traffic, the medical devices scanning and monitoring patients, the defense systems protecting national infrastructure. Every major technological trend of the current era, artificial intelligence, electric vehicles, cloud computing, 5G networks, require semiconductors to function. And as these technologies scale, the demand for more powerful, more efficient chips has grown dramatically. Over the past decade, funds tracking the semiconductor industry averaged approximately 33% annually, more than triple the broad market average for the same period. That number sounds extraordinary, and it is. It reflects a decade of exceptional growth driven by the convergence of multiple major technological trends simultaneously. The forward question is whether that growth rate continues. Semiconductor cycles are real. The industry experiences periods of oversupply and price compression. Geopolitical factors around chip manufacturing and supply chains add complexity, but the underlying demand driver, the world's accelerating dependence on computing power, remains intact. For investors who believe in the long-term trajectory of technology, this sector represents one of the clearest demand growth stories available. Fund 6, the NASDAQ 100. The final fund is the broadest on this list, and in many ways the most accessible starting point for investors exploring performance beyond the standard index. The NASDAQ 100 tracks the 100 largest non-financial companies listed on the stock market. That exclusion of financial companies means the fund is naturally weighted toward technology, consumer technology, healthcare technology, and communications, the sectors that have driven the most growth over the past 2 decades. Unlike the sector-specific funds earlier on this list, this is not a concentrated bet on one industry. It is still a broad basket of 100 major companies. But because those 100 companies skew heavily toward technology and innovation-driven businesses, it has historically outperformed the broader 500 company index. Over the past decade, the NASDAQ 100 averaged approximately 18% annually, consistently above the S&P 500 for the same period. The trade-off is volatility. A technology-weighted fund tends to rise faster than the broader market during bull markets and fall faster during corrections. Investors in 2022 experienced this directly when technology-heavy funds dropped sharply before recovering. The lesson was not that the strategy was wrong, it was that the strategy requires conviction and a long enough time horizon to absorb short-term drawdowns. The strategy that determines whether any of this works. Here is the part most finance videos skip. It does not matter which funds you choose if your investing behavior works against you. The single most destructive pattern in investing is buying when markets are rising and selling when markets fall. It feels rational in the moment. When prices are going up, optimism is high and buying feels safe. When prices are falling, fear takes over and selling feels like protection. But this behavior, buying high and selling low, is the opposite of what builds wealth. It locks in losses and eliminates the recovery gains that follow every historical market decline. The strategy that works is simpler and harder than most people expect. Always be buying. Set up an automatic investment that leaves your account on a fixed schedule, weekly, bi-weekly, monthly, and goes directly into the funds you've chosen. That transfer happens regardless of market conditions. When markets are up, you buy. When markets are down, you buy. And when markets drop significantly, that's when you buy more aggressively if you have the cash reserves to do it. Every major market decline in history has eventually been followed by a full recovery and new highs. The 2008 financial crisis, the 2020 pandemic crash, the 2022 correction. Every one of them was followed by a recovery that rewarded the investors who stayed in and penalized the ones who sold. Recessions and market crashes are not anomalies, they're features of the economic system. Understanding that they're cycles, not endings, is what separates investors who build wealth from investors who destroy it by reacting emotionally to short-term events. The funds on this list can potentially give you access to above-average long-term returns, but only if the strategy holding them in place is strong enough to survive the inevitable periods of decline. Final recap. Let's lock this in. The math is clear. Improving your annual return by even a few percentage points creates dramatically more wealth over decades due to the compounding effect. Fund 1. S&P 500 Growth Companies Only. Removes slower-growing value stocks. Slightly higher upside potential with moderately more volatility. Fund 2. Technology Sector Focus. Concentrated in the companies driving modern economic growth. higher returns historically with higher short-term swings. Fund 3. Aerospace and Defense. Economically resilient sector with government contract stability. Requires personal moral evaluation. Fund 4. Momentum Strategy. Invests in the fastest-moving S&P 500 companies based on price momentum. More active rotation with historical outperformance. Fund 5. Semiconductors. The infrastructure layer beneath every major technology trend. Highest historical return on this list with corresponding volatility. Fund 6. NASDAQ 100. Broad exposure to the 100 largest non-financial companies. Technology-weighted with consistent historical outperformance. None of these are guarantees. Every investment carries risk. The goal is not to find a shortcut, it's to understand the options available, make informed decisions aligned with your time horizon and risk tolerance, and then execute a consistent strategy long enough for compounding to do what it always does. The difference between being stuck and being free is not income. It's behavior repeated quietly over time.